trading, right? They'll appear here out of nowhere, like please start trading. All these kind of yeah, those advertisements which you all know nowadays when you actually log into all the different websites these days. So we're going to discuss about what's this instrument that you can use to trade nowadays. So without further ado, let's proceed with this. Hang on, let me just do a little bit of teething around here. Okay, so okay, a bit of disclaimer. Yeah. Okay, so for today, we are going through this the topic of contract for differences and why traders actually use it. And then we can walk through a bit of what kind of products that in Phillip, what do we offer for contract for differences and how we can actually use it. After this first part of the presentation the webinar for today, we also be going through some of the orders that we can actually use for CFD itself, such as stop limit orders and trailing stop orders. Yeah. So after which we can go to the next phase, which is the about this new product called the contract for these are called FOREX CFD or FX CFD in this case. So we'll just give a little bit of introduction about the this Forex and a bit of the terminology and how to use it, and then for there we can actually open up for Q&A on questions about this contract for differences. Yeah. So about CFDs. So what are they actually about? Okay, in this case, when you look into CFD, that is actually a contract between you as an investor or trader and with us, which is basically the provider itself. To form basically an agreement whereby when at the start initial part where you actually lock in the price, any profit and loss will actually be paid or to be collected in this case to you or to us in this case. So by definition, so this instrument itself allows you to actually to speculate on future price movements of the underlying asset, can be stocks, indices, or even in this case can be a price of gold, of commodities such as gold itself. We are actually owning the underlying asset, meaning that you don't own the other. Example, if you do a share CFD, like example like DBS itself, when you actually start with this contract itself, you don't own the underlying share of DBS, but instead you participate in the price movement of this DBS itself. So for example, if you actually form a contract which has a price of $1 and it actually can move $1.10 or 90 cents itself, which means that you can make a profit of $10 cents per share or lose 10 cents per share itself. You'll be under this agreement, we are obliged to actually give you 10 cents per share if you actually make a gain. Like example, the share price goes up to $1.10 if you actually take a long position. Or likewise, if you actually took a long position and the share price actually went down to from $1 to 90 cents itself, we will need to you need to actually in this case pay us 10 cents itself. So it's actually like a contract between me and you We are only the asset itself. Okay. So why do actually people use CFD in this case? So this is some of the few advantages that you can use it. So number one is the ease of actually the ability for you to do performing short selling. So what this means is that usually there's a terminology that people use that's called you are going long or going short. So if you're actually going long of something like example like a stock itself, that means you are actually anticipating the share price to move upwards. So you are actually taking like some sort of owning this stock in this case, and hoping that after a few days or a few months later, the stock price will actually increase, and from there you can make a profit. If you actually take a short position in this case, so you are actually in a sense selling equivalent of taking a position whereby if the share price actually goes lower, you are actually benefiting from it. This can be you can think of it as you are actually not owning this certain stock itself, whereby you are actually selling it at a current price and buying back at possibly at a later date. So any differences in the price itself, you are, example, if the price goes lower in the near future, in this case, you are actually making a profit because you are actually getting the cash at a higher position and selling at a lower price. Yeah. So you can just feel free to type all your Q&As over there. So after which, during the Q&A section, I'll try to address the questions one by one. Okay. So this is actually for CFD itself, it's much easier to do so because in this case, you are forming a contract between the provider us and with you itself only. If you're actually doing the physical shares itself, right? For those people who actually did shares borrowing and lending, like you do realize it's actually quite a tedious process whereby you have to borrow shares from us after that, and actually have to return it at a later date. And sometimes if there's a need to, to do some the other party that lends you a shares, subsequently sell the shares, then in this case you are being forced, to close your position if they do not have enough supply of shares in the in the holding for those in the shares borrowing and lending facility with each of your brokers in this case. Yeah, so this is one advantage. It's much easier to do short selling using CFD itself. Secondly, CFDs actually by default itself, there's actually a leverage component inside in it. So in this case, you are actually if your position, the position that you take is actually you're in the right position. In this case, you can actually make much more profit as compared to taking a normal position like buying stocks just like that. So it's the ability to increase your profits with existing cash that you have. And thirdly, in terms of accessibility, you can access up to 5,000 counters over 9 markets in with volumes itself. Yeah. So in this case, is basically the ability to short sell. You can trade on leverage as well as you can access to more markets. Yeah, based on our offerings. Okay. So on this term about leverage, right? So in this case, how it works, right? We can take an example for this case with basically a hypothetical counter which is priced as $1. And in this case, we say that you need to provide us with a margin requirement of 20%, meaning that you have to put at least 20% of the value of the contract or this exposure that you wish to take, right? To put it up front as a collateral, meaning you put it as a cash deposit before you can take a higher position. So if we look at this example itself, assuming that you take a position of 10,000 exposure of $10,000 in this case, if the share price grows up by 10%, means goes from $1 to 110. In this case, your position maybe is actually increased from 10,000 to 11,000. In this case, you make a profit of $1,000. But just take note that you're actually only putting in $2,000 and you make $1,000 out of it, meaning that you have actually gained 50% based on your capital outlay. Well, likewise, if you actually take a long position and it goes against your favor, go down 10% due to some negative news itself, right? Then you'll be making a $1,000 loss, meaning you're losing half a capital. Yeah. So in this case, all your gains and loss will be magnified in a sense, yeah. So actually, you have to be careful when you actually use this itself. Risk management is actually quite an important tool. Yeah. Likewise, if you actually do the reverse, which is basically doing the opposite of it, meaning that you actually take a short position, meaning that you profit from the fall in the share in the asset price itself, or in this case the stock price, assuming that it goes up 2% and down 2%, and this time this counter give you basically up to 10 times the leverage, meaning you only put 10% of the amount, which is $1,000 capital outlay. If the share price goes by 2%, you make goes up 2%, which goes against your short position itself, you will lose actually $200. Whereas if you actually take basically if the share price goes down instead, then you actually make a profit of $200. So this likewise will translate about 20% and gain and loss and gain respectively if the share price goes up and down. So yeah, also this actually illustrates the effect of using CFD and their leverage effect. So in Phillip itself, we actually offer multiple products over here, depending on what you are looking at. So if you're looking at stocks, in this case, we have equities whereby you can use it for shares. So for shares itself, we do offer the normal CFD as well as this CFD direct market access, which is currently available for the local market in SGX. So other than that, we also offer, in this case, you're looking at indices itself. You can just want to trade CFD over a basket of basically the market itself, over a basket of all those blue chip counters. You can feel free to use our world indices to actually trade that. Or in this case, you want to trade gold or silver, we have a commodities CFD on that. And you want to trade all those currency pairs, something that's quite quite volatile right now is anything that's related to US, like USD, right? You can see it has been moving quite a bit. Yeah, so you can actually go to our this FX CFD for it. So I'll be going through the topics on the equities, world indices, and commodities first. So, okay, so for this case, I'll start with the shares first. Okay, so for shares itself, in this case, you are actually participating in the price action of the underlying counter, which I just explained. What this is just forming a contract, and basically the price movement move against you or with you, you take the profit and loss from there. Please take note that our CFD itself, we don't quote additional spreads which you see in the exchange itself. So what you see on basically on the platform itself is actually what you see in basically the underlying stock exchanges itself. So in this case, we don't add additional spread to it. So rest assured, what you see in the CFD is the same as what you see in the stock market. In terms of the contract size, how much you can trade, right, is the same as what is being illustrated in the basically in the exchange itself. So in this case, you can just go to our website to see what's the lot size you can actually participate. So this will actually allow you, to go into a long position, short position in terms of the lot sizes in this case. So the markets that we serve currently for individual shares can be shown over here. So usually in Singapore, we have it here. And if you want to go to Malaysia and the UK itself, we also provide exposure to that. Yeah, but the certain counters we actually allow the long only, or certain counters we don't have access. So all this can be found in our website. You can go into there and see the counters that you wish to long or short. Yeah. Okay, so when you look at the normal shares CFD, then we actually mentioned this thing called the direct market access. So what is this DMA CFD about? So the difference between the two is that for this DMA itself, it allows you to participate in the order book. That means in the exchange. So meaning when you place the order through the DMA, you can actually see your order being reflected in the exchange market depth. If you right now, you can actually access all our services. In this case, right now SGX is giving all the market depth services to basically all our POEMS user itself. So if you haven't opened an account with us, please do so. Yeah, I think in this case you can actually access to all the market depth access, which I think the exchange has been quite generous in giving out. Yeah. So over there, back to the topic. For the DMA CFD itself, you can actually, as mentioned, you can actually let your orders be keyed into the exchange, and this allows you to participate both as basically the pre-opening segment as well as the closing sections of the exchange itself. So in this case, all your orders that you're being submitted can be reflected in the basically in the order book in this case. So all your orders in this case, when you submit over, is actually based on the last time price itself. Whereas for the share CFD itself, your orders are actually done based on basically your B and ask, which is reflected in the platform itself. But if you look at both, right, the commission rates for share CFD, if you actually look further after this seminar, right, you can realize that the share CFD, the commission is lower as compared to the DMA itself. So this is actually the summary of it. So for shares, this direct market access DMA itself, you can participate in the order book of the exchange, and any liquidity itself, you are actually actively joining it in this case. Yeah. So in terms of capital outlay, in this case, we allow up to 10 times the leverage. So in this case, you can put from 10% onwards, and you actually key in the CFD counter itself. It will show you the basically how much you need to put in when you actually place your order. Commission wise, for DMA itself, it starts at 0.2% onwards, and for shares itself, if it's actually index constituent counters, those blue chip counters, it will be actually start at 0.128%. Financing costs itself will actually be reflected over here, which you can look at the specific counters, and they will actually display to you when you have the POEMS account itself. So the percentage actually quote in per annum basis, which is as long as you hold it on daily basis, you'll be charged daily. Yeah. So that is actually for stocks, individual stocks. I understand that some of you, maybe if you're not too sure about the stocks itself, but you know about the market, whether it's going up or down, right? And you want to enjoy basically the diversification of the counters, basically of the indices itself, right? That means not banking on certain counter, to move, to go, up and down with this kind, right? Something with slightly lesser risk appetite. You can feel free to use our world indices CFD. So over here in Singapore, in using this index itself, right, you can participate in exposure in up to eight different countries. So this include Singapore, China, and also in Taiwan itself. So in this case, we have various indices which can be classified under the cash derived basically the index CFD or cash correlating. So in this case, for our site, this Singapore index CFD is actually cash derived, meaning that the price performance is actually matched based on the underlying index, which we actually replicate directly. Whereas cash correlating is basically the performance of the basically the products that we have for the indices itself, right? Is actually highly correlated with the index that we're trying to match. So in this case, it's actually we use it through a correlation, so it won't match 100%, but it's quite highly correlated. Yeah. So in this case, we give you up to 16 times leverage. So basically, price movement tick right. Basically, that if basically an index move about 1%, right, that means your position, if you actually put in your cash outlay, right, your position may actually increase, up to like 16% in this case. So in this case, we give up to 16%, 16 times the leverage, meaning that you just put in 6% of the margin requirement. So in the website, you can see that we have quite a lot of those indices that you can use. So next we're going to the commodities that we have. So in this case, we are actually participating the price of the commodities. So in question for Phillip itself, we actually allow the gold and silver CFD in this case. So these are actually the specifications that we have in there. Yeah. So this allows you, in case if you just trade on both pure cash and basically in stocks and basically in bonds in this case, you can consider using this CFD to actually go into other asset classes such as commodities in this case. So it's like an alternative, into invest into gold ETF, etc. So just to take note, by using this CFD itself, right, using this kind of financial instruments, is as compared to buying in gold futures or silver futures itself, you need not worry about the storage and freight cost involved, because you will understand that for futures itself, right, the price itself also is being there's actually the storage and insurance costs, all these costs itself that's being factored into the price of the future itself. So if you're actually looking into participating in the spot price of the basically on the gold prices itself, right, our silver prices, you can actually use our contracts over here, and you can see the commission for the contracts itself. As long as the size is large enough, we can give you quite a competitive commission in this case. Yeah. So just an example, so what you mean by contract per side, right? If you actually, example, you take this USD 100 CFD, right? That means you're actually buying this 100 times the price of the USD gold itself, right? If you actually long one contract, right, you'll be exposure to with 100 CFD itself, and the commission you pay is only about USD about $5 for that one contract. So if on the other hand you want to take a smaller size, for example, you just want to take only 5 times basically the gold USD contract, right? Then you can actually look at the USD 1 CFD and take 5 of the 5 contracts of that. So that will actually translate to the same commission of about 5 USD for that long contract. Okay. So that's for the first 3 products that we have over here: shares, bond shares, as well as the indices, as well as the commodities itself. So usually, how we can use CFD itself, right? First thing, can we do it through speculation? So speculation will be taking a long and short position, just as it is, right? So that is just how we mentioned on the leverage during the leverage example. That's like how you actually use it to to take the position in this case. But on the other hand, you can also use it as a hedging position if you already have some holdings in the cash position, such as in stocks or in basically ETF units. You can actually use CFD to hedge your position. Yeah. So in this case, if the market goes up, then you can actually use CFD, take the and in this case, just let it go up. If your markets go down, right, you can actually take a short position for can be in this index, or in this case like other counters, to actually try to protect your portfolio value with it. So in this case, we can talk about direct and cross hedge. So direct hedge will be straightforward. If you actually have, for example, like a position in a SGX, right? You want to hedge it, then you use shares CFD to actually to take a short position in the SGX CFD contract to short. So this is literally just what direct hedging of the asset. That means you using the same asset class to actually to cover your basically your value in this case, your counter value. But however, there's also another term called the cross hedging. I mean, in this case, maybe in this case you are unable to find this instrument, maybe because the cost is too high to use it. So in this case, you use other instruments such as there's a lower cost. Then in this case, there's some high correlation between this the what you have and also with this CFD that you're going to use it to protect your portfolio in this case. So I'm going to go through an example of each of these two to illustrate what is this hedging all about that you can think about using it. So first thing first, I'm going about direct hedge in this case. So for direct hedge, in this case, we think about this scenario whereby you hold 100K worth portfolio worth of an index ETF in this case, and basically this ETF itself, the underlying index in this case is at 2,600 points, which it looks a bit familiar with what we have in Singapore in terms of indices. Yeah. So in this case, assuming we have this index CFD in this case, which has a contract value, priced at for one contract itself is actually priced at $1 per index point in this case. So one contract value will be about $2,600 in this case. Yeah. So if we have this margin requirement based on the world indices criteria of about 6% itself, right? Then in this case, this one will mean that your initial capital outlay in this case will only need to take 6% of the total position you need to protect your portfolio in this case. So to form this close to full hedge in this case, right? That means basically to protect your entire close to 100K worth of portfolio, we need to take this position or a short position of this case, right? That means the opposite position of what you're holding right now of 100,000 divided by the value of the contract, which is approximately about 38 contracts of this index CFD to cover it. So the initial outlay for this case would take about 6% of it of this total contract value. So that will be need to just put in about close to 6K for this short exposure in this case. So using that, your total initial capital that you need to fork out to to hold this kind of hedging in this case would total up into 105,000 around there. Okay, close to 106K in this case. So we take about these two scenario. So if the index actually goes up about 10%, you can look at a new portfolio itself. It actually rose about 10%. That means for 100K, it moved to 110K. If then in this case, your corresponding index contract in this case, because you take a short position in this case, so your value actually goes by down by 10%. So your new contract, this CFD position right now, right, is now valued at 88, close to 89K as compared to the initial position of 98.8K. So in this case, if you actually calculate the value of the basically of your position, basically your net profit and loss itself, right? You're actually not taking a slight loss of the value as compared, allowing your portfolio to move up and down. Yeah. So this key thing is that you actually try to maintain the value of the portfolio in this case. Yeah. Likewise, if actually true to what you actually anticipated, because when you actually do this hedging itself, you're actually anticipating that the portfolio value may go down because the index actually goes down. So it already go down, then when the new portfolio value will be down by 10%. But because you actually take a corresponding CFD contract position of a short position of it, so you actually gains by 10%, close to 10%, and gain by 9,800K. So in this case, your position you just get a slight little difference because of the contract size difference, basically the rounding issue. So in this case, more or less, your portfolio is actually being protected in a sense from all these market gyrations. So this is assuming that the correlation holds during this market price change itself, and we haven't considered basically the commission and funding charges. Yeah. So this is just an illustration of how you can actually use CFD to hedge it. So now we'll go into the second topic of cross hedging. So now cross hedging is actually using some other instruments to to cover the position of your current holdings. So if you actually take an example, like you are actually instead of holding a ETF, index ETF in this case, but you are actually holding a portfolio in this case that, on average, right, move about 0.7, basically about 70% of the market movement, index movement in this case, like a correlation of 7%, correlation of 0.7 in this case on average itself, right? Then you want to use the index CFD to actually hedge it. So we actually use this same index CFD to hedge it by using this correlation to try to protect your portfolio in this case. So assuming the same specifications for your index itself, currently about 2,600 points for index, and same contract value, like one contract is about 2,600 with the same 6% margin requirement. Right now, if you want to protect your portfolio in this case, based on the information that you have, right, your portfolio is about move 70% of the market index in this case. So in this case we can take less contracts to actually to protect your portfolio. So we take a short position of this index CFD, about 0.7% of this contract, the sizes, which takes about approximately about 27 contracts to actually to hedge a position. So right now the value of your CFD itself will actually, you only have to take 70K worth of the index CFD, and capital outlay will be in this case lower because of the basically the lower correlation of your portfolio as compared to the market index. So likewise, your question, in your mind will be, what if my portfolio is those hyperactive one, example like those bank stocks, or like currently the airlines, if they really move quite hyperactive, right, and the correlation is higher, then sorry to say, in this case you need more contracts to hedge it. Like if you're actually using this cross hedging strategy in this case. So likewise with the same thing itself, based on basically your calculations that in terms of your correlation is actually only less than 1, basically don't move as much as what the market move, right? In this case, you need not to put so much capital outlay for your index CFD position. So in this case, you only put about 104K in this case as compared to the previous close to 106K itself. Then if you work out the math, if the market index goes up 10% up and down in this case, we take basically the bull case where the index goes 10%, portfolio values goes about 100. Basically your portfolio, basically those diversified portfolio, because it actually index goes 10%, and basically based on history is it moves up about 7%. It will move up about 7%. Because of the 0.7 correlation itself. So the portfolio value for the shares is 107,000, meaning go up by 7K. And the index contract, right, because it's basically based on the market performance itself. So you're actually taking a short position. So your value, your CFD value in this case, your position itself will actually go down by 7,000 as well, because of the basically it tracks the index. So in this case, your P&L, because it doesn't match 100% in this case, but it actually protects your portfolio value by quite significantly. In this case, the example itself, you only lose about $20 in this case. On the other hand, if you actually take the index actually went down in this case, your portfolio value may go down by 7,000. But in this case, your index CFD position actually, because you take a short position, it goes up by 7K. So this actually negate each other's price movement, and just give you more or less protects your total initial capital in this case. Yeah. So this is actually how this hedging actually works out to protect your portfolio value. Likewise, correlation holds during the price index price changes, and charges such as commission and funding charges are not included in this example. So things about this CFD itself, right, when you place the order, just take note that for the share prices, if you want to queue, right, you can actually queue at a plus minus of 20% of the lot size price of the counter itself. For DMA, which is the direct market access, because you are actually accessing the exchange itself for the pricing, basically placing orders. So your queue restrictions, basically how high you can place based on your last done price itself, is actually at, in more concrete terms, which is the bid points, bids in this case, which is determined by the exchange. Yeah. Forward indices, you can put at a plus minus of 5% of the what you can place in your orders in this case. take note that if you actually select market orders, in this case, it's still subject to the fields based on the prevailing volume. And for this case, when you send your order, in this case, it can be the order status can be shown as order received. That means it just be queue over there. There's no order being done. If it's done completely, you can see usually it's like how you trade stocks. In this case, you show the status as done. And if it's not done fully, you show as part done. Then you see like how many orders has been executed, how many orders is still outstanding, etc. And if it's due to some reason or some that your orders it cannot be accepted, you will show as a rejected order. Then, for example, like please contact a broker. Then your broker will tell you what's going on, etc. Something to take note: if you're actually trading shares CFD, right, your CFD order cannot be used to close up a DMA CFD position and vice versa. So if you actually enter, example SIA, right, you enter a long position for SIA, in this case for normal share CFD, please do not use the DMA CFD, right, to close SIA CFD, this DMA itself to close the position over there, because you end up with a long position in the share CFD and the short position in the DMA CFD itself. So you are actually offsetting on both ends, and you're actually incurring finance charges for both the position itself. So this is something you want to take note. So remember, share CFD, you want to close, use the same share CFD. DMA, close using the same DMA. Yeah. So some general terms when you actually use CFD itself, because it's leveraged in this case, you have, in this case, there will be this concept called the margin call in this case. So it can be triggered if the prices move against you. Please refer to our information sheet to see how it actually can be triggered. Usually it will be triggered if actually the value or basically the equity balance that you have, which is basically the outstanding cash you have taking into account all the interest as well as the P&L. If actually less than 20% of what's your contract that you have, right, then you will trigger a normal call, normal margin call, which you have 2 days to satisfy, including the day that we contact you that you have a margin call, which can be seen if you actually log into your CFD, basically the POIUS itself, and you go to the CFD, your portfolio status, they will be triggered over there. Or in this case, if it's forced even further, right, less than 5% of the value, you have to satisfy it within the same day itself, 3 p.m. So the cutoff for each day is at 3 p.m. itself. So please take note, if you actually if it moves against you, try to close the position or top up in this case. Yeah, but usually I will suggest that it's better to close the position, because if you actually top up and stuff and the market goes against you, unless you're then confident that this is just a temporary blip, then okay, then yeah, in this case you can actually incur losses that are more than what you deposit lah. Yeah, but likewise the rewards can be quite sweet. If actually move with you, and you can actually earn quite a bit for it. Secondly, for dividends, right, for share CFD, usually when they declare dividend in this case, on for shares in this case, you have to wait until the payment date, and they give you the dividend in this case. For CFD, you can get it like almost instant. After estate itself, you can get it almost instantly through the dividend adjustment onto your prices in this case. So if you have a long position, right, you'll be credited the dividends into your account to take into account basically the dividend itself, the movement in this case. And if you have a short position, you have to you have the cash being deducted onto your cash position to actually adjust for the dividend. So in this case, you don't need to wait until dividend payment date. You still will get the effects of the dividend straight away. Okay, there's also this thing about contract rollover. So if you actually enter a position for CFD on in our platform itself, as long as you don't close your position, like take a short position, you don't buy back your what you have your position on your existing position, you don't actually go and cover it, right? You will be considered as not closed, you'll still be keeping this position all the way until you close it. That means you take a offsetting position in this case. So for this case, our contract usually is actually at 30 calendar days after start of the position in this case. So at the end of the day 30 in this case, what we'll do is we'll do a simultaneous closing of the old contract and create a new contract for you to continue your long or short position that you have taken. And any unrealized P&L as well as interest charge for the 30 days itself will be payable. So in this case, we'll deduct from your funds and maybe if you don't have enough currency, sufficient cash or in a certain currencies, interest may be actually be generated. So it's very important that near the 30 days itself, you need to take a look to see how much is the cost of holding it, and from there you can make your payment in this case. So one example for this is that we take this example that for a share price that goes at $2, in this case, this is one of the position where you hold for 41 days, and in this case, you actually sell it at a profit. But however, during the days, due to markets are up, basically the up and down in this case, if you actually roll over at basically at 180, which is 20 cents lower, then in this case, on the end of the 30 days, you need to cover for we will actually deduct about the interest of the cash, right? The actual cash about 20 cents per share that you hold in this case, as well as the interest incurred over this 30 days in this case. So in this case, we still initiate a new position, which will start price at 180. And for this case, you will still be, in essence, like holding a position whereby if after 11 days it goes up to 230, then you realize the profit of when you close it, you realize the profit of this 50 cents. So although it's the actual P&L is 30 cents, in this case you have to first cough out the 20 cents first before you gain the 50 cents in this case. Yeah, and any interest that you have along the way during the rollover will have to be paid. So this will be actually the first part of our CFD, basically the walkthrough in this case. So right now, we're just to talk about basically the type of orders that we have in CFD in this case. So namely our limit orders, basically and other more fancy orders such as start limit orders. So we're going through on that, how you can actually use it. So limit orders is quite straightforward, which is the best price that you can key in for buy and sell. Basically, it's like how you queue for the best price in this case. We're going to be going through more on the more advanced orders such as the stop limit, trailing stop, and etc. So just to define actually what is stop limit orders, is actually an order whereby you have basically a trigger price, and once the price actually trigger, that price itself will submit a corresponding buy or sell order. Yeah. So this is actually used to enter a new position or exit a outstanding position when the price actually reach the limit of the trigger price that you have. So if you actually use it, for example, to cut loss, like if you want to cut loss, right, or to take profit, you can actually submit this stop limit order for you to use it as a risk management tool. So to illustrate, in this case, assuming that you actually want to take a buy stop limit order, in this case, meaning that you take a short position, but the share price move against you. So you submit an order for this case to actually set it at 390. So if you actually trigger at 390, in this case, you will submit a buy order of 395. So meaning that any price that actually is actually at 395 and lower, right, it will be executed. So subsequently, if the share price really move up, trigger order 395 in this case. So when during the price when it triggers at 390 in this case, this order type itself, the system will recognize that okay, this 390 has been reached already. Then they'll submit a 395 order in this case to actually try to cover your basically your short position. So that will actually cover it. That will actually cover it based on the prevailing market volume that you have. So that will actually cover your position. Yeah. If not, you don't have this buy stop limit order, then you try to key in the order itself. Maybe the price movement might have moved up and down, and you might have to actually buy back at a higher price. So this is one good advantage of using stop limit order. So right now, if I want to do a sell stop limit orders, right, assuming that this is the position you have, like example, the price movement has been moving up, then you enter a long position at 390. So it get executed and it goes up, but however, is somehow or another it did a U-turn like what today's bank has done. So yeah, it does basically double top. That means it's basically a bearish indicator. And in this case, you're afraid that the momentum have already stopped already, or maybe you realize a mistake. So I want to protect myself. I submit the sell stop limit order, put it at trigger at 385, and the limit price to be 380. Meaning that once if the share price actually reach based on what your criteria can be last time price, bid price, or ask price, it hit 395, right? Then you will submit a sell limit order at 380. That means any price that you see in the market, right, that's 380 and better, right, you will actually accept the order and free up the basically your order in this case. So in this case, the share price actually, really did hit below 380, and after that, it will actually trigger this stock price, basically this order in this case, and you fill your basically your order that you wanted to place in this case. But however, there's basically a risk of using this stock limit order, especially when there's gaps. So gaps meaning that there's when at one time, like basically the price is at because due to many liquidity, they see that bid and ask is quite wide. Then you submit such a stock limit order. In essence, is that when the trigger price is being triggered, but however, the next best price, example, if you take example of the like the sell stop limit order, like example, if you want to submit an order, then the sell limit order is actually at a certain price range that you want, but the next best price, the bid price, is actually way lower than the sell stop limit order that you place, right? Then there's a risk that your sell limit orders may not be executed, and the share price may continue to fall further. So it's very good. It's actually a good practice to look at basically the market depth when you submit this stock limit orders to see whether it's still relevant or not. So for this case, as an example, when your position is in this case, you take a short position in this case at this 70 cents, and right now when you see that momentum is going down, then suddenly some buyers, some big shot actually went to eat up, shoot all the way to at the current price of 7.15. So in this case, 71.5 cents. So in this case, you try to place a buy stop limit order, to cover a short position, to actually key at to trigger this order, such that once the stop price is actually triggered at 7.40 in this case, you submit a buy order of 75 cents, buy limit order of 75 cents in this case. So any outstanding orders that people queue at 75 cents and lower will be executed. But however, is somehow or another the price gaps up above 750, like 750, 77.5 cents above, right? In this case, you will see that the price order will be executed above it, and your orders will be a buy limit order be hanging down there 75 cents. And if the market momentum is quite strong, keep going upwards, then that's when your stop limit order fail to fulfill its purpose, which is to cut loss. And this is when you need to take drastic actions to do it manually in this case. So there's a chance that your stop limit orders may not actually work. So it's important that you key in appropriate limit price order, such as a balance, such that you don't want to suddenly buy back at such a huge to realize such a huge loss in this case, and also you don't want it to be not working when you want it to be working in this case. So that's for stop limit order. Next, we'll go through about the trailing stop order, which is the setting a percentage. So in this case, instead of you set a hard value, in this case, you are setting a percentage below the current market price. So this is like a trailing stop order, because you based on the market percentage price, right? So you actually adjust as the price goes up and down, etc. So the good part of this is the usage in this case, right, is whereby if you want to place want to capture all the gains, but you don't want to keep monitoring, like decide which price you want to actually to cover your position back, right? You can actually use this trading stop order to let your basically your profit your profits continue to roll in this case. Then when the market start to turn the opposite, basically start to exhaust and then take a reversal, then in this case you can actually cash out with a nice steady profit from the previous run in this case. So this trading stop orders is actually quite a popular way of you to use it. So for example, in this illustration, in this case, for you take a long position of 60 cents. So you put a trading stop sell order. So in this case, you let the step to be 10% of what you last time price. So right now, when you take this position is 60 cents. If the share price is right now touch through, right, you go in, right, then you very sway, right, then the share price actually dive to now 54 cents in this case. Then okay, at least you lose you don't lose all your basically you don't lose more than what you have, and just 10%, you just give it to them. Of the exposure, not the basically your capital. So this is something you want to take note. You just take it as you lose about 10% of the exposure, and that will be it. So in this case, we just move up. Okay, sorry. In this case, if you allow the share price, for example, move all the way to $1 in this case, then your indicator stop right will instead be changed to 90 cents. And subsequently, if the share price move down, right, and hit the 90 cents in this case, then you will submit a sell order, and you can actually sell your position at this 90 cents in this case. So in this case, you exceed it at 90 cents, and you get again the tidy sum of this 30-cent profit that you had during the run. So this is trading stop order for you to use it. So likewise, we have the trailing stop order. So this is okay, let me just see whether, okay, I think it's the slide in this case that we have a position. So this is just now I mentioned. Yeah, so sorry for the arrangement of the slides. So this is what I just mentioned, to protect your gains and limit losses automatically. Yeah. So in this case, for the slide itself, if we move up, in this case, current price is 74 cents. Then based on the step that you put as indicate as 10%, then will be moved up to 67 cents in this case. So likewise, if the share price drop below and somewhere it bounced back at 68 cents, bounce back up again, because it didn't touch the 67 cents. So in this case, it will not be triggered. It goes up again to 83 cents. And right now your stop limit, basically the stop price that you're sitting at stop order, move up to 75 cents in this case. And after that, basically the market, the price movement moved into into the exhaustion phase. Basically after the run, then okay, start to cool down already, maybe just to take a break. Then that's when you will trigger and you close at 75 cents. And subsequently, the machine move up and down itself is no longer related to your position because you already exceed your position already. Okay, so the next order that we have over here is an if done order. So this is actually activated until when the parent order is executed. So in this case, if a certain order is done already, right, then they will submit a next level order for you. So this is like if one order is done, then okay, then you will submit another order. So you think of it as your computer language. So if a certain criteria meet already, okay, you do this order. Then after that, yeah. So if a if else is like in computer terms, it's like if else. It's an if else function in this case. So in the structure, like it's like two or more stacks. Like one sequence is have been done already, right? Then you use, and then the second order will start to come in. So this is ensure that what you do it is in sequential order. Yeah. So if you want to have more advanced order, this is one way you can actually use it to do so. So we take example like SIA, right? If you want to place if a done order, so in this case you actually place a SIA counter like long at 1480, which is quite a way back in this case, but this is for illustration purposes. So yep. So in this case you actually long it at 1480. So yeah, when you're holding a long position, then in this case you take a sell order for a limit order which is at 1490, and subsequently if this is done, you want to place a buy order to actually buy limit order for this counter called SPC in this case. So if the sell order is done, then you do a buy order. So once it's filled, then the order buy order of 640 is submitted in this case. So subsequently, if the price for SPC actually went down, right, and actually reached the price itself, then you will submit. Then in this case, you will get your buy order for this SPC will be filled as well. So in this case, you close your position for SIA, and you also get your long position for this counter SPC in this case. So it's actually basically a sequential order that you can actually submit it in this CFD in this case. Next, we have this thing called the one cancel order. So basically is that if there's one order that's been done already, then you cancel another order. So this is quite useful if you want to do an envelope, basically a range bound strategy in this case. So in this case, like you take a long position in this case, then if you want the share price, you want to take profit at a certain range, then you can submit this order such that if we reach the price of this case, you can take profit. And subsequently, you can have other order for you to cover your short, in case the market actually turns against you, you can actually cover your short loss. Basically cover your your capital by doing a stop loss order. So this is actually a mix of take profit and stop loss. You combine it together. So this is actually a one cancel order. So is to take profit as well as a stop limit order to cut loss in this case. So when you submit this example, you're taking a long position at 350 for this example. You submit basically OCO order such that you have the sell order for on both ends. So you want the first sell order, to put a limit order to take profit at 390, and you want the stop order for the sell stop order to be at 340. So likewise for this OCO order, you can categorize it as sell OCO or buy OCO. So for this case, we're doing a sell OCO, meaning that you want to take a short position for upwards and downwards as well. So for a long position, in this case, you want to cover your position by taking such an order itself. So if the market subsequently moves into this way, your position in this case, when you move upwards in this case, once you reach this trigger at 390, you'll be executed at 390. So if you're ready, then your sell stop order in this case, because your first order has been executed, so you automatically cancel the sell stop order. So subsequently, if the share price goes down in this case, you will not be triggered in this case. So this is quite useful for you to to set your mechanical trades, whereby you want to take profit at certain level and want to cut loss at certain level. This is a very good order for you to use. So for another example, for this another counter at a price of 112 in this case, you execute this same thing, this OCO order for sell OCO in this case. You sell at 114, 114 in this case, and to stop, but there do a stop loss at 106. So you pay your OCO to be in this way. So subsequently, if the share price actually dies below that, reach $1 and below, you feel quite safe in this case, because your sell stop order in this case, you put a limit order as 106. So that will actually cover your further downside risk in this case by doing OCO. So in this case, we're talking about the fifth advanced order. It's called the contingency order. So this is more complex than if done order. So in this case, you may not have the order to be done in this case. So in this case, you want to have the certain counter to reflect a certain criteria in this case, so that you actually have the submit a condition, basically an order for you once this criteria that you set has been fulfilled. So it's like more advanced version of if done order, if you look at it. So in this case, if you want, in this case, it's actually for you to enter a position of a certain counter, or to close a position when some other securities, such as not as what you want. In this case, if I want to, like example, if you take one position, like example, okay, one example will be like China Aviation. Yeah. So in this case, right, example, if I want to let SIA be a proxy for China Aviation, because usually if I have this hypothesis whereby oil prices, basically the demand for aviation oil will actually be reduced if actually the flight actually, based on this COVID-19 will be cancelled, right? Then in this case, if SIA share price falls to a certain range that I triggered, that falls to a certain price range that I have, right, then I will initiate a sell order for China Aviation. That's one way that you can use this contingency order to do so. Yeah. So, okay, example, which is this now delisted NOL, whereby somehow, in this case, certain, okay, I just keep it over here. So this company itself took over, in this case, have been privatized because of in this, I think in this case, the earnings wasn't that good. So that's why in this case, it was privatized by the management somehow, due to the, in this case, or the performance by the management itself. So in this case, we see that we submit this order. Okay, so once you actually set a condition for this NOL, with the bid price in this case reached below 143, so instead of last known price in this case, you take a bid price. That means not the actual executed price in this case. You submit a sell order for this case. So this will be triggered. So once you touch this bid price in this case, not the actual price is being executed, then you actually fill up the order for 143, and subsequently if the share price goes even lower, you'll be safe from that. Okay, likewise, we have Singtel and StarHub over here. So if in this case they are actually in the same industry, so if you actually have a position whereby if you look at your peer in this case, the price in this case, if the hard price starts to go down, and because of basically they're in the same industry, they are somehow related in this case, if you believe in the theory on what you call it. Yeah, if believe that basically the theory that basically markets are basically based on industry, they move prices in tandem in this case. In this case, I understand that there's the concept of mean reversion. So basically, if somehow in the industry, right, if a certain counter has tends to outperform their peers in this case, because due to actions of a certain industry, somehow another over time the share price will actually performance will actually be brought back to the industry average. Yeah. So if you actually believe in this kind of theory in this case, we can actually make it such that the hard price, bid price actually at 289 at 289 below, right? It reflects that price in this case. Then I will submit a sell order, because in this case I might think that Singtel itself might also in the over the next few time periods actually may also go down as well. So I'll submit this sell order. And likewise, it actually did go down in this case. Your sell price is actually triggered based on this contingency order in this case. So any price actually 813 and better, right, will be executed, and you actually be safe from the subsequent price fall in this case. Yeah. So this is actually for the order types we have for CFD. Okay. So right now I'm going to the third segment, which is our this new FX CFD that we have over here. So before we talk about FX CFD, we talk about what is FOREX in this case. So for FOREX, it is actually refers to the foreign exchange. So it's whereby basically participants come actually go into trade about currency in this case. So so in this case, before we actually do any transaction, basically buyers and sellers, they will agree on a certain rate that we have before making transaction. So this is quite the same as what you did in the money exchanger when you want to go overseas, which I think may take quite a while for us to do so. So it's better to stay safe right now. But we can in this case, if you want to start saving up for your travel, you can start looking into converting your currencies right now. Yeah. So so in this case, back to the topic, forex in this case is what is different in the forex market as compared to the stock exchange is whereby we don't have a centralized exchange like SGX or Hong Kong exchange, to exchange your one basically to have a market, where you can see the buy and sell straight away in one single area. So this is actually traded over the counter, means between parties or within one-to-one for them to change their holdings in this case. Exchange their currencies between two parties. That means there's no central market for that. So to illustrate, centralized will be like an exchange whereby you all routed to the same location. So basically, what the price quoted is actually only the price that you actually take place on that one single place. However, for OTC market, basically yes, it's done between brokers and dealers, and also with banks one another. And basically, they actually executed can be over electronically, or in this case offline. In this case, basically through the phone orders or through the fax mail and central. So basically, they are transacted with one another directly. There's no one single place that you can see what's the actual price has been done. So that's the difference between the two this OTC as well as exchange, centralized places such as the exchange. So for FX terminology in this case, for this case, for FX terminology, in this case, you can see that currencies can actually, when you look at it, is being quoted basically in two currencies, for example, Euro USD. So how you can actually interpret this is that you can have the base currency example for this case is actually the first currency you see, Euro. Then the right-hand corner is actually the quoted currency, USD. So if you look at this term itself, right, it's based on the price of base currency usually as one unit of the base currency, in this case, Euro. Then based on it can use to be exchanged by how many USD, which is quoted currency, or the second part of this term itself. So example, if you look at in the forex market in this case, or in the money changer, you see that if Euro USD is quoted as 1.08 something, right? It means that 1 euro is valued at in US dollars term 1.081 something like that. Yeah. So this is how you look at on the forex in this case. Also, we have this thing terminology called the PIP, in this case the PIP. So in this PIP, in this case, if in the forex, basically in the forex space or in the currency exchange space, 1 PIP in this case, on ordinary in this case, right, if it's not quoted in the second currency, basically the currency itself is not quoted in Japanese yen, is actually the 4th decimal place of the currency pair. If it's quoted in Japanese yen, it's actually instead may move to the 2nd decimal place of it, because you know Japanese yen, the numbers can be in, like example, can be in thousands if you actually quote it. So that's why the decimal place is at the 2nd decimal place, whereas for other currencies it's at the 4th decimal place. So okay, so in this case, when we actually quote the currencies, we can actually quote it in direct quote or indirect quote. So direct quotation, right, depending on your location, in this case, if you actually use the basically international market, the main currency that people use to quote, right, in this case, main currency or the domestic currency, we use it as USD. So if we give a direct quote, in this case, basically the second currency, right, basically we use it as USD. So any currency in this case we use, like, will be based on any other currency like euros. Like example, previous example, euro USD, right? So this case is actually being reflected as a direct quote, because the price in this case of that currency is in USD, which is the currency that we're mainly using it in. So if you want to do the basically to quote it in the reverse way, so in this case, like the price of the USD in other currencies in euro, right? The reverse convention, we call it the indirect quote. So this means that the quote of a fixed amount of a domestic currency, usually in 1 unit, in the other country's quantity in this case. So to take as an example, in Singapore itself, if we look in the Singapore market, our domestic currency is in SGD, Singapore dollars. So the direct quote of USD, right, in this case, if we look in the Channel News Asia itself, it will be quoted as USD SGD, means the quoted currency is SGD. That will be the direct quote in this case. So in this case will be example like 1.4 something. So that means $1 of $1 US would actually they meet in this case the quote will be at $1.40.5 in this case. If we look at in the indirect, it will be the inverse of it, which is SGD USD. That means one SGD dollar, which is the domestic currency in Singapore, will fetch the price of the 0.71 US dollars in this case. So this is a naming convention for the FX in this case, which depends on the domestic currency, on where you are actually situated at, in which place, in which country, or if it's international, usually USD will be used because of it as a reserve currency. Okay, so there will be this term that we have to call the cross-currency pair. So this will be the pairs that does not involve USD. So in the international space, because USD is used as a currency, basically used as the reserve currency, so we use it as the main currency for us to compare as the direct quote and indirect quote. So for cross-currency pair, is being quoted as two different currencies that we have. So in the international space, we can quote it as, like Singapore SGD and Malaysian Ringgit, or Europe, euros and British pound, the exchange rate, basically what's the FX rate. So all these rates that does not involve USD, right, are actually called the cross-currency pairs. And usually for cross-currency pairs like this, right, the spreads, like basically the price between the bid and ask, right, will be wider because of liquidity issues. So in FX itself, we do have this thing called the major currency pairs. That means those currencies that have been traded quite frequently in the FX space. So as you can see over here, they are all related to USD because USD is the reserve currency. So all these currency pairs are the most frequently traded in the forex space. So as also we see it's like Euro USD, followed by USD Japanese yen, whereby they use this as a Japanese yen as a safe haven currency for people to to hedge their as basically their cash in this case, in case any what I call it, adverse news that's in the market. We also have the British pound and other currencies you can see over here. Yeah. You do notice that some all those currencies they have under these major currency pairs are actually under in the those developed economies in this case. So why do people actually trade forex in this case as compared, in stocks in this case? Because in terms of the preferences, because firstly, you can actually trade in the market 24 hours, 5 days a week, meaning that from Monday to Friday it will be continuous trading. Basically, if you somewhere halfway through midnight you can't sleep already, then your hands are itchy, you can feel free to go into the forex market and trade. Yeah, feel free to do so. Likewise, in terms of commission, we don't have any upfront commission for your trade. So the only thing you have is basically the P&Rs. That's the only thing you need to worry about. Forex is bidirectional. Basically, you can take a long position of the currency. Example, if you want to long, example, euro, right, for the currency pair, that means like euro USD, right? If you actually long euro, you're actually taking a short position in USD. So you have to go in a pair in this case. So if I think that maybe in this market, euro or the European markets will be doing better than the US market, I will take a long position. Basically, I take a long position in euro USD, such that if the currency of euro against USD actually appreciates, the meaning that 1 euro can fetch more USD dollars, that's when I actually make a gain out of it. So this is actually the beauty of forex. Yeah. Liquidity, yeah, because in this case, the market for forex is definitely way more liquid as compared to the stock exchange in this case, because of the number of transactions that's needed in terms of currencies over the world. Forex is much more liquid as compared to stocks. Usually for trading of for forex itself, we have leverage in this case. So in using our platform itself, our leverage can go up to can go up to 20 times of your capital outlay, because right now MES regulations, they have come down to you can only have a minimum capital outlay, basically the requirements of 5%. So you can actually gear up to 20 times of your existing exposure. One thing is that the platform itself, when you actually use our platform, you don't need to worry about all those how the fees that to have to pay in order for you to trade forex. So on our side, using forex in this case, you can actually place your money there and wait for opportunity to go in without any additional platform fees. And likewise, no one can corner the market, meaning no single person can actually influence the forex rates, unless you're talking about some big major government or something like that. So other than that, any individual person, right, eventually they can't of course absorb all the supply that in the forex now, because the market is very, very huge. So for this case, we have this one of the ways you can actually gain basically in the forex market is the FX CFD. So what it can do is allow you to gain the exposure to the underlying spot forex pairs using CFD itself. So in each of the contract sizes that we actually offer it at the sizes of 10,000 of the quoted currency. We don't have any commission fee or that, and continuous trading mode in this case at the timing, etc. for entire from Monday all the way to Friday or Saturday morning in this case. Yeah. So each pip itself will actually, based on the term currency, is actually a movement of $1 for 1 pip, and the margin requirements will go from 5% onwards. Yeah. So this is actually our FX. Yeah. So in terms of pairs, we have up to 30 pairs available. So our most competitive spreads that we have is actually the main basically the currencies over here. So on average for Euro USD, our average one of the best basically rates that we have is 0.7 pips for Euro USD. You can take a look in our platform. This is actually our average is quite close to this 0.7 pips. Not that you say, oh, this is the best, but actually the actual pips it can be like 2 point something. Nope, for us we keep it quite close to our best pips that we have in terms of the spread in this case. So our latest best that we have, right, if you want something that's more than basically more than the usual major currency pairs, we have those more exotic ones like Euro Japanese yen or something like British pound Japanese yen. We have it as well. So this is something you can take a look in our website or in the platform itself for you to explore. So why do people actually use our FX CFD? Number one, no commission, no finance charges by holding it. So in this case, it's quite different from others like your other asset classes whereby you have this commission and finance charges. For FX, we are actually quite generous. In this case, we just have the bid and ask that you have in this case for you to to trade. We have stop limit orders to cater for your risk management in case you take a long position, but you're afraid that the market can move against you, or in this case, you are doing some momentum trades. You want to enter a position once you hit a certain your own criteria. You can use stop limit orders to do it. Our spreads are quite competitive, quite close to what the best spread that we have that we publish it over in our website. You can trade 24 hours, 5 days a week, and you don't need to have a separate CFD account to do it. So as long as you have a CFD account, you can use it to trade Forex as well. And also, no maintenance fee and account opening fee for using FX. So how do you actually trade FX in this case? So this is an example on how you can actually enter a position for the Euro USD. So in this case, you can actually go long or go short, and you have the bid and ask over there. So for your information, bid is actually the best price on the queue for you to to long a contract, whereas us is the basically the best price for you to on queue to short a contract. So if you want to take a short position immediately, like you can actually sell at the bid to take a short position. For this case, that means you are expecting the USD to strengthen against Euro, then you can feel free to sell it. Whereas if you want to actually want to enter a position straight away, you're bullish about Euro against USD, right? You can just buy on the ask in this case. So order types available as of now, we have the limit order as well as stop limit order. Yeah. And if you're wondering how much you need to have a margin, right? In this case for your position, right? We already have the calculation on the margin requirements, which is stated in the trade blotter in this case. Yeah. So as an example, how it works for FX CFD in this case, suppose you buy 10 contracts of, in this case, we just work an illustration. Example, you take 100 value long this USD SGD. In this case, you're actually bullish that USD is going to go higher more than $1.40. So the value of the contract is 140. In this case, based on the minimum margin requirements, in this case, you need a minimum of 7,000 Sing dollars to enter a position. So in sense, you are longing the USD, shorting the SGD in this case. So based on those scenarios, okay, first one, if it works to your favor, USD approach against SGD to $1.42. Okay, you're actually make again. Right now, your new contract value is 142,000. Then right now, the profit will be actually based on that, it will be $22,000, and this will translate into 38.57% gain on your based on your capital outlay of $7,000. Likewise, if it depreciates to 138, it means you're losing 2K out of it lah. So likewise is it will be a loss in this case. So your gains and loss will be magnified because of the leverage effect of FX. Another example, if you actually sell short in this case of this Euro USD, because in this case you're also quite bullish about USD, but in this case you don't like Euro, you are not so favorable about the Euro, the pound, in this case Euro itself. So in this case you actually take a short position, and margin requirements for that will be 5,400 USD for a value exposure of 108 USD. So in essence, you are actually longing USD, shorting the Euro in this case. So likewise, made on the two scenarios in this case, if this USD to quoted currency actually you appreciate against USD to by 2 cents. In this case, your new contract value will gain about 2,000 USD. But in this case, because you are taking a short position, so in this case, you are actually losing out about this 2 cents of USD for this contract in this case. Then in this case, what you will be losing will be 2,000 euro, USD in this case will translate to 35.7% loss based on your capital outlay of 5,400. On the reverse, on a better scenario whereby you are right in this case that USD actually appreciates against Euro, and if you do a reverse, will be Euro depreciate against USD to $1.06. in this case, you actually make a gain of 2,000 USD, which translates to 35.7% gain. Yeah. So likewise, because of the leverage effect of the contract of this CFD, in this case, you magnifies your gains and loss. So in this case, for forex, in this case, please take note, if you actually hold your position, beyond the same position on this day. So for this case, on Singapore time for 5 a.m., which is actually based on the daylight saving mode. Depending if it's in daylight or non-daylight, they will be at 5 a.m. and 6 a.m. Singapore time respectively. So if you hold your positions over more than a day, in this case, there will be this condition called the swap points. So it's actually based on the currency's interest rate. It depends on the currency's interest rate. So if there's any differential between it, example, Euro is having negative interest rate, whereas USD is having a positive interest rate. So you actually hold Euros over long, or if you actually long this Euro USD, right, you can actually incur interest by holding this position. Whereas if you're actually doing the reverse, you're holding USD against SGD, right? That means you short the contract because of the interest rate that is actually positive, right? Depending on our swap point in this case, you can actually gain basically the difference in this case. So in essence, right, if we put it in layman terms, if for this currency pair, where whichever currency that you long it, right, you will earn the interest on that. If you short the corresponding interest, corresponding currency, right, you're actually paying the interest for that. Yeah, clear cut. Okay, we also have another thing called the settlement and rollover for the FX CFD. So please take note, like for spot forex CFD, right, is actually translate a value at 2 working days after it's actually the transaction basically settlement, which is actually done at this T2 in this case, except for the Canadian currency, which is T1. So the actual currency is delivered to counterparty of the trade itself. So during this position itself, right, if we actually hold it over basically more than 1 day, we have this thing called the rollover, which means that we say we just bring forward the settlement date, and this is done daily and conducted by us in this case. So in this case, you no need to enter, do the physical rollover in this case. We will do it for you. So as long as you want to hold more than 1 day or so, you rest assured that behind the screen in this case, we're already doing the rollover for you in this case. So as an example, in this case, if you place a trade at basically on Monday in this case, so the value date of the contract after that, the transaction date will actually be on Wednesday itself. So likewise, if you actually keep holding it long, basically over a period of time, as long as you keep holding it, right, the value date in this case will keep rolling over and over and over. So in this case, once you go to Tuesday, that means you will just take another contract, to hold it for your long position, and you keep rolling all the way until on Monday in this case. So take note, if you actually close your position on Thursday in this case, you may actually encounter this a longer period of this swap points, this duration over a longer period. Instead of 2 T plus 2 will be over on this duration of T over 4. So this is something you may want to take note if you're actually holding position over more than a day in this case. So this is actually gist of what our this FX CFD is about. Yeah. So just to let you know, for new account opening for CFD in this case, if you actually have this wish to open a new account, please take note of these opportunities whereby if you open this account and within 2 weeks you actually fund this account with 5K up to 25K or more, right? You get to have this free CFD trade in this case. So every time you put in, example, you open this account, you put in 15,000 into it, then your first 3 trades in this case, you can proceed to place a trade, and subsequently we'll offer the rebate to you in terms of crediting back to your basically into your transactions in this case, basically back to your CFD account. So it will be returned to you as in the form of rebate. So this is actually to reward you. In this case, when you open an account, you straight away use it now, activate it with funding. In this case, we give you free CFD transaction. But take note, you can refer to this promotion website that this free transaction has basically some expiry date. So this one you need to take a look and see by when you need to use up this free CFD transaction in this case. Also, if you trade frequently with us, we have this frequent traders program, whereby if you actually each month, if you trade frequently on that and it hits a certain rate, basically the commission in this case, we will actually reward you by giving you no credits for you for trading with us to reward you as well. And once your commission, right, for CFD itself, if you are quite well versed and you trade quite frequently, we will give you special commissions for your Singapore, US, as well as Malaysian CFD in this case. So feel free to take a look at the basically TNCs for our these frequent traders program to see whether it suits you in this case. Because in this case, we reward our traders in this case for trading with us in this case. Likewise, if you want to get your friends to join you and if you feel that our CFD platform is quite useful, just feel free to get them in as well. So every successful referral, right, you get 150 CFD voucher, and your friend will also get another 150 CFD trading credits for your account itself. So it's a win-win situation as long as your referee actually manage to place trades three trades in a basically your CFD in this case, or this direct DMA in this case, within 2 months of account opening, then both of you will get free trading credits. Yeah. Please take note, when you actually refer, right, you need to let him to fill up this referral form, which can be downloaded in promotions website in our Phillip CFD website in this case. Okay, so if you have further queries, you can feel free to actually contact me at this my email address, as well as my basically the phone number. You can actually give me a call or drop me an email in this case. Yeah. So so if you have any other queries or you want to check with your trading representative, feel free to do so. Ask about them about about CFD or how you can actually use it to actually to improve your investments as well as your trading activities. Okay, Q&A. I'll just go through some of the questions that you have with us. Okay, I have one query from here, which is asking about what's the difference between CFD and options. Okay, so options itself, right, is actually a kind of financial contract whereby you can have this is called a call contract for option. That means that you have a strike price, and if the price goes above it, you have the gains as basically based on the price that the difference between your strike price and your basically the current price you have. But just that for options is in this case, if you look at the downside, basically you actually lose the if it actually goes beyond basically in the opposite direction of your strike price, right? Basically you can just lose the value of your what you call it, the value of the option that you purchase. In this case, your loss is limited and your gains can be more than that. But there's also another component which is called the expiry date. So once the time value expires, then in this case, you can't hold the option forever. So in this case, when it expires, then you base on the value, then you get the gain you lose the entire value of the option. For CFD is more onto taking a position with us, and as long as you don't close it, right, basically your P&L will continue to run until you close the position. So in this case, for option right now, for now we don't offer options in volumes itself, but in this case, it's something that we can actually look into it. So feel free to stay tuned in our website to see when we manage to do so. Yeah, so there's something that you can actually stay tuned on it. Okay, we have another question with us on the pre-closing and basically opening of the basically the trading platform itself. Okay, so I just go to the slides in question. So usually for exchanges in this case, right? Usually, example, you put it in SGX itself, right? They usually have the pre-opening segment, like basically people can queue to place the order during the timing of 8:30 to 8:58 p.m. Oh, sorry, a.m. my bad. So 8:30 to 8:58 a.m. right, they can start to queue the orders to place the orders over there. Then, but the thing is, the market won't execute the orders that being placed. They don't do the matching of the basically the prices that's being placed over there. So this pre-opening and closing segment will mean that the auction of the buy and sell right will only be executed at the closing time in this case. So for this case, if you are using DMA, you can actually participate, because the thing is that whichever orders they submit into this DMA under DMA order, our team, right, our CFD team will actually place a corresponding order for you in the exchange in this case. So in this case, you will be participating in the order book of the exchange. So this is one advantage of DMA as compared to the shares, the normal CFD that we have, because on the normal CFD, your orders will not be placed in the same order as in the exchange. So you can't participate in the pre-open and the pre-closing. Yeah. Okay, so in this case, what is DMA orders done on the last time basis? So in this case, on a last time basis, is basically what it means is that when you place your order, basically when you queue it, is based on basically the price and time priority. What it means that when you place your order at a certain price, in this case, you place your order in this case, right? Once is some other person actually go and submit the order on the exchange itself, like to place the order on the example, you queue at 120. Example at one. Okay, so let me just show you one example. Okay, we take example of this. Example, if you actually place an order over here, like a DMA order of sell of 390, assuming it's 390, yeah. And subsequently, you place it there, but if the bid and ask for the share CFD, it stays at, like around 380, 385, something like that, right? Subsequently, if the share price actually, moves towards 390 and is being executed at that, right, at 390, then your DMA orders will be executed based on execution basis. Whereas for share CFD in this case, right, it won't be based on the actual exchange, whether the last time price will be done at that price. So for that share CFD, what is this mean is that whichever price that you see, right, when you execute, right, will be based on the bid and ask that you see on the trading screen in this case. So that will be the difference between the last time price and the bid and ask. Well, of course, bid and ask, when you submit, you'll be based on the bid and ask that you see on the trading platform. Whereas for the last time, you'll be based on whether the order is being executed or not, based on the price and also the time priority. Okay, for the reason why commission for DMA CFD is more expensive than shares than CFD. Okay, the reason behind is because for DMA itself, there's involved another additional step whereby our market makers will need to submit the order to the exchange in this case. So in this case, it involves an additional step for you to to participate in the actual order of the exchange. So whereas for shares CFD, the normal CFD itself, right, is only done between me, basically our providers, and you directly. So the basically the number of steps for you to actually get your orders, they get your orders routed, right? Basically for DMA is an additional layer of steps for your orders to be sent to it. So it involves more effort, basically more steps involved. So that's why it's slightly more expensive. But likewise, if you actually value the thing about basically participating in the pre-market market open segment and closing segment, right? Feel free to use DMA, because in terms of value wise, like, you see there's a value, it's better for you to go into that instead of going for cost. Because I understand a lot of our clients, like, who goes into very cost conscious, right, may have to think through this thing of look into value in this case. Because if you look into value, your cost perspective will change in this case. If you keep talking about looking for cost, right, you may miss out about the gains in opportunities, because there's a saying that goes, it can be penny wise but pound foolish. So it's good to look in the big picture to see whether is it worthwhile for you to pay the penny, basically the amount, in order to get the kind of returns that you have. Okay, so we have this thing called, what's the difference between cash derived and cash correlated? Okay, cash derived means that basically the underlying, basically the CFD actually replicates the index directly, Whereas cash correlated means that they don't replicate the underlying index. But in this case, they find something that's closely related to the index in this case. That means they don't match directly, but somehow if the price movement of the index move up and down, right, this CFD price will actually go along with it quite closely. Yeah. So this has an implication whether your price order in this case how you actually execute, because if you go for cash derived, right, that means you have a greater certainty that a movement, for example, 1% movement in the index would actually reflect like close to, in this case, close to 1% of the CFD price directly in this case. So it's actually 1 to 1, quite closely to 1 to 1 as compared to a cash correlated, because maybe for cash correlated may not match 100% into it, which is they track less, slightly less accurate than cash derived, but in this case it's still quite highly correlated in this case. Okay, we got another question, which is can we buy actual real physical gold volumes? For actual physical gold with us, right, if you want to buy actual one, we do have that kind of facility in Phillip Futures. So if you want to buy and own, right, we have the facility in Phillip Futures for you to do so. But if you want to gain exposure to gold itself, right, you can do it in the securities arm, which is on our side, either through CFD, or you want to buy the ETF version, you can go to the exchange to buy the SPDR Gold ETF. Yeah. So if you want to gain exposure to gold, you can use our facility in Williams. If you want to buy extra gold or you want to trade a gold futures, you can go to our futures arm. Okay. So we have okay. So in future I can try to talk a bit slower. Okay. Yeah. So sorry about it. Yeah. So okay. So can you explain again about don't buy CFD DMA to offset? Okay. So okay. Let me just go over here. Okay. So the term of this is possible that for a same contract on SIA itself, right? You can actually go long into the to a certain counter, example like in XGX. So you can actually get a position like into the stocks version of basically the normal CFD to elongate, and you can also take a long position in using the DMA version. That means the direct market access. So in this case, you can submit order through the exchange for the DMA, and you can just take a position directly with us with basically the normal share CFD. So if in this case, taking an example of this, taking like SGX, you want to long a position with basically with normal share CFD, right? If you long it, if you long a CFD in this case, with basically with us directly, like under the normal stock CFD, share CFD, if you want to close a position, be sure to close it using the same CFD, which is a share CFD, and not using the direct market, this DMA CFD. Because in this case, if you use the DMA CFD to do it, what it takes is that, example, you long this share CFD, long share CFD, right? You will subsequently submit a DMA version of the short CFD in this case. In essence, you are taking a contract which is the share CFD long position, and also a subsequent another short position, open position on the DMA version. So in this case, we have two active contracts, one in the shares CFD, which is basically on the long position. There's another one, a short position, which is DMA. They won't offset each other. Yeah, that means you have two open contracts, one in one contract, which is the shares one, another one is with DMA. Yeah. So in this case, they won't offset each other. You will be treated as they are opening long. Basically, you have two open position, and likewise, interest. Basically, the interest charges for taking these two contract will actually be incurred in this case. One for the shares CFD, and the second one will be a DMA CFD. So far, so clear? Yeah. So for next question, for platform to be used for trading Forex in this case, if today we're talking about the contract for differences using CFD to actually to track FX. Yeah. So for this question, for this case, you can actually use it to trade FX using the Forex platform in this case. Sorry, my bad. You can actually use this FX using this CFD platform to trade Forex in this case. I understand that on the future side, Phillip Future side, they also have another platform, which is for MetaTrader. So MetaTrader will be more for people who want to trade, in sizes of 100K and above. That means those who want to trade the normal FX contract. So if they want to trade there with a lot of those algorithms that you want to key using the this MetaTrader 5, you can actually go ahead and open this Phillip Futures MetaTrader platform in this case. But likewise, if you are trading in sizes like in 10,000s above or something like that, you can for the ease of using and like for trading in this case for these sizes, you can use our CFD platform to trade using the FX CFD. Okay, I have this question whereby you need to go to the ABS investor portal to complete the CFD module. Yes, this one you have to submit it. Okay, you have to complete. And just to let you know, usually if your basically your certificate once you completed, however, it's more than you took more than you take 4 or more attempts like in order for you to pass this certificate itself, right? You may need to actually to head down to basically to actually a trading representative for him to actually to explain to you what's this CFD platform in this case, because we need to ascertain that those people who are using these instruments, like these financial instruments, they understand what is going on with basically the mechanics of contract for differences of this CFD itself. So that's why when you actually submit the certificate, it doesn't mean that automatically that you can use it to get access to CFD. You need to ensure that you pass it with basically with a lower basically as few attempts as possible. Because if you took many attempts to pass it, right, usually we'll still need an additional confirmation by our side to check with you whether to go through with you basically a mechanism of CFD before we say that okay, we got thumbs up to trade CFD on your own. Okay, so in this case, you want me to explain what is Forex as interest rate on currencies? So basically, okay, so for the interest rate of both currencies in this case, right? So each currency in this case, because on currency itself, on the corresponding basically on the rates itself, they do have their own they earn interest rate for each of the currency in this case. So if, for example, if I okay, let me go to that. Okay, let me just go straight. So for this case, interest rate itself, right? Basically, if we actually, you think of it as putting your money into a bank in this case. So when you're actually doing Forex in this case, right? When you okay, so back to the naming convention over here, which is at this page. So if we take an example of this Euro USD, right? If you are actually if you're actually buying basically taking longing of this euro dollars and and shorting this USD, right? You are when you're taking this long position, in essence, you are actually like like lending the money in basically you're taking position and putting the money like in euros, right, and earning their interest rate and putting money in the deposit in euros, basically in euros, and actually you're actually okay, let me just rephrase again. In this case, exactly in this case is like if you're taking a long position in euro USD, right? You are in essence like taking the money in putting the money into euro side and gaining the interest in euro dollars, and actually, you are actually borrowing money in USD. So in this case, you are earning the interest in terms of the euro sides, their interest rate, and you're actually paying the interest in for USD. So this is actually in essence that when you take a long position, right, you are actually earning the interest that you're actually taking a long position, and you're paying for interest in the short position. So in this case, do you earn or lose interest on the base and quoted currency? In this case, we are actually doing it in terms of the swap points. So which is, okay, let me just go there, which is earning the currency that you buy and selling the currency that you sold. So based, if we go to this example, for USD HGD, right? If you are actually taking a long position for USD, right, you'll be actually earning interest on the USD side, and you're paying interest for HGD. So for your question on that, you can actually by taking this long USD short HGD, you're earning interest on USD and basically losing interest on HGD. Yeah. So in this case, if you want to take a course for CFD, we have a few modules which you can take, which is being conducted on our this seminar. Yeah, and likewise, we also have, which is actually time to time we have all these seminars that you can actually learn more about CFD in our basically in our seminars in the website, as well as we have our information sheet which can read through to see how this actually, or what are all these specifications about CFD about. Okay, for CD, okay, CP. Okay, so in this case, we have one person will say that if you want to trade CFD, right, for stocks and basically for stocks itself, right, if you buy and sell same day, right, the only cost you incur is basically the commission charge. For the finance charges will actually will not be charged, because once you hold overnight, in this case, that's when finance charges will actually be incurred. Yeah. So this is something for you that know. If you trade intraday, right, you just only need to worry about the commission. And obviously also the bid and ask if you have it as well. Okay, do you need to open a new points account for Phillip? Okay, for Phillip Futures, in this case, you have to approach our Phillip Futures arm, in this case, to actually to open an account. So over there will be an account manager for them to open their, to do the basically the future side. So feel free to head over to our futures, give them a call, and they will actually assist you to actually open a futures account. Likewise, if you want to open with us, the futures account, feel free to make an appointment with us in any of the Phillip Investment Center. Then we can help you to actually open the futures account. Yeah. In this case, for Phillip Futures, you will have basically they give you a different basically futures ID, etc. So in this case, you can refer to them to actually to see how you can actually link it to POEMs, because actually with POEMs platform, you can actually use it to trade futures as well. So, okay. Okay, so in this case, I see that you have, okay, for one of them, like you have actually passed the CFD ABS certificate. Okay. Okay, I think if you have that, right, it's best to bring it over to your dealers, give them a call to ask, check with them, how come you didn't pass this CKA this CFD website, the portal in this case. Yeah, because usually if you actually have the certificate and you have the details over, then by right they should be able to adjust it to CKA about basically your customer knowledge assessment. Okay, so other than that, okay. Excuse me, sorry, bad. Okay, so so back to the question that okay. Okay, I have this question from for a person who's still not sure about this cash derived and cash flow related. So okay, so to be clear cut, just to give you an example, right? For cash related, right? Very straightforward. You think about ETF. If you look into shares or ETF, right? If I want to replicate, example, a certain basket of goods, right? I just want to buy into in this case if I want to to recreate basically the position of this ETF in this case, right? I will go into buy go into straight away, like example go and buy one to like how the index actually basically a basket of how the goods are. I will buy one to one such that it actually to recreate the same proportion of the holdings of the of this ETF in this case. Yeah. So example, if the index, example, put 20% into stocks, 40% into bonds, etc., right? If I want to recreate that, I will do the same thing, 20% into these stocks, 40% into bonds, etc. That is cash derived. That means you do a one-to-one exact replication of the underlying in this case. For cash correlated, we don't do that. We don't do the 100% matching in this case. We will find in this case, it will be like something like example, if something move a certain percentage up already, we find something that they actually move quite close to what happens in for the underlying. So in this case, it's not 1-to-1 100% match in this case. So that is the difference between cash derived and cash correlated. Cash derived means you replicate exactly as what the index basically what it comprises into. You replicate 1-to-1. Cash correlated will be you match the performance of the basically of the index and you match it quite close to it. So this is the difference between the two of it. Yeah. Okay, and so your second question is you have TRs that have two login password. Yes. So for one, they will be for your stock in this case. The second one will be for your futures. Yeah. So in this case, if your TR in this case can do both stocks and futures, that will be the best. Then he will handle both in case. If not, the other one who's handling your futures will be purely taking care of your futures. Basically their position in this case, basically for your futures guide, and for the one in the stocks in this case will be handling the stocks in this case. So if you want to choose your own TR, you can feel free to do so by approaching basically for futures they have in this case. If your basically your own TR can do futures, you can feel free to approach them. If your basically your other for futures in this case, we have a few account managers. You can go to their website and you can actually find them. If you think that they're actually quite good, you can actually contact them directly and let them be your account manager. Yeah. Hang on. Okay. So let me just exit this. Okay. Let me show you the website for the futures. So the website to go is phillipfutures.com.sg. So let me send it to you. Okay, let me share the screen first. Hang on and I say y'all can't see the screen. Okay, so this is actually the screen for basically for Phillip Futures. Okay, so to go there, you can actually go to this is the website phillipfutures.com.sg. So if you want to open an account, you can actually open it online, or if you want to go to through the other means, right? Example, to go to the Phillip Investor Center to open, you can also feel free to do so. So if you want to choose your basically the excuse me, my bad. You want to find someone, account manager, to handle your case, you can actually go into in this case support. Then there's in this case you can actually find that basically your what I call it the persons that you want them to actually to handle your accounts in this case. So in this case, each of the futures manager will have their own what I call it the futures manager for you to do the what kind of the trading, etc. Because futures in this case is right now is not the kind of yeah, it's actually quite more advanced in terms of normal investment into shares and bonds, etc. So if I want to go into that, yeah, so yeah, feel free to contact us in one of our places. So this is actually the lines that you can call us. Yeah. So there's also one question in this case. If you have a quote for the DMA and cash position for the same position, right? In this case, you can actually okay, let me see if there's a quote for DMA and okay. So our platform, as mentioned, is the same as what we have quoted in the basically in the exchange in this case. So in this case, there won't be any spread for CFE in this case. So the commission will be charged separately as compared to the CFE that we have in the platform. Yeah. Okay. So so for this lady in this case, if you want to change your TR, you feel free to contact your trading representative, and they will ask you to change basically your if you have an existing TR that you want to change to someone else, you can feel free to send an email to them. Then they will actually follow up on this case to you lah. So this one is not to worry lah. Okay, so back to the question, the spread, just to let you know, you can choose basically it will be the same as what you see in the platform. So in this case, there won't be any additional spread that we have for CFD in this case. Yeah, so this one is quite clear cut. Yeah, so I guess this is for all for today in this case. If you guys got any queries, just drop me an email. I just follow up on your case. But if just have to apologize if I didn't respond you fast enough, because these days I do have quite a lot of queries in this case. So you may if you have any questions that you want to ask, just contact your trading representative, and also if you have any queries, you can drop me an email as well. Yeah. If not, just end this section over here. Just leave this screen about 2 minutes. Afterward, I just close this session. Thank you so much and stay safe. Yeah. If you got any queries you want to further clarify, you can drop me an email. Then in this case, I'll contact you directly. Then in this case, I'll send you the relevant details as well.